Hello, guys. Good morning, good afternoon, good evening for everyone who is watching us today. My name is Big Tim, and I'm bringing you another episode of Make Money with Big Tim. Today, yeah, today is actually a great day, and today is Children's Day. So I want to use this opportunity to wish everyone Happy Children's Day, and to the Muslim faithfuls. I'm going to wish you people. Sorry, I want to wish you people Happy Eid al Ada. That's if I got it correct, but Happy Salah though. That's the one I know I can say, yeah. Happy Salah. So today we're going to be talking about ETFs and stocks for beginners. ETFs and stocks for beginners. So you're ready to start investing and you have one very big question that is bothering you, and it's, should you buy individual stocks or should you invest in ETFs? Some investors swears by stocks. Me, I like stocks. While others says ETFs are the faster choice for beginners. Yeah, I also did ETFs too when I was starting. I'm not gonna lie. So who's right? In this video, I'm going to explain the difference between ETFs and stocks, the advantages and disadvantages of each of them, which one or which option makes the most sense if you're getting started. So by the end of this video, you'll be able to know which one to invest in and approach your investment goals. So let's get in. So firstly, we are looking at stock. What is stock? Let's start with stocks. See, when you buy a stock, you are buying a small ownership of a company, of a huge company, just a fraction of the ownership of a company. For example, if you buy shares of companies like Apple Incorporated, Microsoft Corporation, or Amazon.com or Inc., anyone, you become a shareholder in the business. Do you get? If the company grows and becomes more valuable, your shares will increase in value. If the company is a company that pays dividend, you get your own portion of the profits distributed to the shareholders. So this sounds simple enough, or isn't that true? But there's more to the story. So what is an ETF? An ETF stands for Exchange Traded Funds. Think of an ETF as a basket containing many investments. Instead of buying one company, you are buying a collection of companies in a single investment. For example, one ETF might hold hundreds of large companies across different industries. That means when you buy one ETF, you instantly gain exposure to many businesses instead of relying on just one. Like for example, when you open an ETF, you can get like Apple Inc. in it, you can get Amazon, you can get different companies altogether. This is one reason ETFs has become extremely popular among beginner investors, because you have like too many investments or too many companies in one. So let's go over to the advantages and the disadvantages. So firstly, just as we looked at stock firstly, we're going to be looking at the advantages of stock. So let's talk of the benefits of investing in individual stocks. The first advantage is higher potential returns. Do you get? If you choose an exceptional company early and it grows significantly, your returns can be impressive. A successful stock investment can outperform the broader market. Now let me give you a breakdown of what this means. Let's say now, I remember, was it Okumu oil or Geregu oil? I remember that was it Tony, and there's this, is he either Tony Enumen or $10 invested in him and his brother. They did it when they were small, like when the stock was still a young stock. Then later they sold it for like after 5 to 10 years, and the amount he cashed out was up to like, it was either 144 million or before 144 billion or so from it. Now they bought it when it was cheap, very cheap, and they kept it for a long time and they sold it later on, and they got high reward and their investments grew and tripled. It's not even triple times 10. It's 10 tupled. That is, if you understand what I mean. Yeah. So the second advantage is more control. You decide exactly which companies you own. You can invest in business you understand and believe. Like me, I'm not going to lie to you. That is how I invest. I invest in only companies that I know that are being used on a day-to-day basis. Like for example, I invest in Apple. Everybody buys Apple. Like Apple is one of my best investments so far. So everybody buys the iPhone. So there's no place you get to that you not see anybody using iPhone. So it's a day-to-day products that people use. But please, this video is not for promotional services. It's just for like educational points. The third advantage is excitement and learning. Many investors enjoy researching companies, following earning reports, and learning how businesses operate. Individual stocks can be both educational and engaging. Now, let me give you something. Let me play down something that you need to understand. See, one thing about this stuff is that you get to understand when you want to go about stuff, you get to understand how the companies work, what is making the companies work, and how to make the companies work for you. See, you don't just wake up one morning and like invest in something you don't understand. I was trying to I was doing a research on Dangote's refinery stocks, the one that are about to come out. Yeah, I saw a post. The person was like, everybody's rushing Dangote IPO, Dangote IPO. Now, there are some people that will just rush and go and buy it, and when the thing does not rise, they will just dump the stock and sell it. He was just explaining everything to me, and I was like, yes, it's true. Some people don't understand that investment is just all about that, and they just think it's something you just put money and it bounces off. So that's not the way, it's not how it goes. And that's where we're going to end the third advantage. So we're going to the disadvantages of stock. The disadvantages of stock, let's discuss the first one. The first one is higher risk. If one company performs poorly, your investments can lose value quickly. See, if you invest in one company and you don't understand how the company works and the company just performs poorly for a particular period of time, you tend to lose much money because you did not invest in multiple, you just invested in only that one. So when that one falls, yours falls. The second disadvantage is more research is required, and truly more research is required, because sometimes before I buy stocks, I don't used to sleep at night. I'm not going to lie to you. I don't know about others or all those social media content creators that are going to be lying to you. I don't sleep at night. I research. There are sometimes I even research to the extent that I go down to US government um, um, websites to be able to check out some stocks and some companies to understand how they work. So I do my research and I calm down. I don't follow the trends. I understand the company's finances, the competitors, the industry's trend, and the future prospects. See, I've gotten to the extent that um me I my dad is a professor here, so we used to discuss most of these stuff, you guess. So there are some times that we'll just sit and I'll be like, Daddy, I predicted that this thing is going to happen. I see it happen. It's not, I did not just predict it, it's not prediction. It's because I followed analysis. Analysis is what gave me the answer, and I did it and I got the answer. So you don't just wake up one morning and just come and buy stock because everybody's buying it, or you're doing something because everybody's doing it. Nah, it's not gonna work. The third one is emotional investing, and this is very stupid. Let me tell you why. Now, most of you see that Dangote sugar is rising and you rush and go and buy it. That's emotional. You're not being like, I don't know the English to use, but you're not doing a perfect research, or there's nothing perfect though, but you're not doing good research for it. You can't be emotional. Allow it. Follow it up. See, I told you that I am into forex trading. See, one of the best things that makes you a good trader is being able to understand the market and following the setups of the market. You cannot just wake up one morning and just say, gold is rising, and you just rush and buy gold, or you buy USD, Euro USD, and you expect it to fly. It's not going to fly. You're going to make a huge mistake. So you have to like sit down, understand the stock, and try to know what is going on. That's why many beginners, they buy based on hype or social media posts or fear of missing out. And this often leads to poor decisions. So we are going over to the ETFs. I don't want to waste your time. Like I said, the advantages. The first one is instant diversity. Instead of owning one company, you own many, and this spreads the risk across multiple businesses. Do I need to explain that? No, that's like not putting your egg in one basket. Simple. The second advantage is simplicity. You don't need to spend hours researching on individual companies. Many ETFs automatically track a market index. So this one, you don't need to like sit down and start looking for this website and that website to research and do that. No, it's not gonna. You just need to just calm down and just put and choose wisely while doing it. But you need to do research, but not as much as stocks. The third one is lower risk. And because your money is spread across many investments, the failure of one company will not even impact on your portfolio that much. It's going to look like just like small, just like when you put like, let's say you have 20 eggs and you share it into 4 baskets, and one egg break inside basket A, you still have basket B, C, and D to be able to keep up. Do you get? And the fourth advantage is that it's beginner friendly. ETFs make investing easier for people who are starting out, and truly does that. Because let's say, for example, there's this S&P 500 are the top 500 companies in the US. So imagine one of the top 500 companies in the US start flopping. You see that the other 499 will be able to help you out, and you get what you want. Now let's go over to the disadvantages because there are no time. Or there is no time. Sorry, I don't know why I'm speaking blunt throughout today, but that's it. The first one is lower upside potential. Since ETFs are like mini companies and they usually won't match the performance of a single superstar stock, you get? It's a collective power, it's not one. So if it's just like where you're saying that, just like in a car, let me use a car for example. If one tire is flat, the three cannot run faster. It's unless all the four tires are full and they are running. That's when you see it running fast. That's one. Two, less control. You don't personally choose every company inside the fund, and that's true. Like the S&P 500, sometimes when I started newly, I did not know how many companies were in the S&P 500. I just had to go and do my research to be able to get through it. Then I now understood the companies that were there, that they were the top 500 in the US. So that's how it works. It doesn't just come to you like, you don't just choose the ones you want. The VO, all those ETFs, they don't just come like, I want Apple in here, I want Google here, I want it to work. The third disadvantage is management fee. So most ETFs charge small annual fees. These fees are usually low, but they still exist. See, a stock does not charge unless it's your broker that is charging you for the stock. But for ETFs, they charge annually. You can see it's not, they will always come to collect small money. They may not collect it hugely, but they will be collecting it bit by bit. So now let's go ETF versus stock, which is safer. If safety is your priority, ETFs generally have an advantage. Imagine investing all your money into one company. If that company struggles, your investments will suffer significantly. But now imagine investing into 101 company in a diversified ETF. Even some companies perform poorly, others may perform well. Diversity will just help you to reduce this risk, and that is why financial experts always recommend diversified funds for beginners. Now, ETF versus stocks, which one makes more money? This is the part where people get very confused. A single stock can outperform a complete ETF, but it can also underperform. There is no guarantee that anyone can perform more than the other. ETFs typically aim to deliver overall performance of the market of a group of companies, while stock can just produce larger gains because you are investing directly on one and it carries greater risk. Now, higher potential rewards usually come with higher potential risk. Do you get? So if you're hoping to make more money and you do your research right, it can be stock, it can be ETF. You never can tell. So what do I recommend for beginners? If you are completely new to investing, ETFs are simply the starting point. Why? Because they provide diversification, require less research, help reduce the risk of relying on one company. And that does not mean that stocks are bad. Me, I told you I prefer stocks to ETFs though. Many investors eventually own both. I do own both. I'm not going to lie to you. I have like S&P 500, I have VO, and I still have like stocks like Apple, Google. I like dividend paying stocks. I'm not going to lie to you. So as it's increasing in value, they're still paying me dividend. That's why I like it. So a common approach is building a core portfolio with diversified ETFs and then allocating a small portion to individual stocks if they enjoy researching companies. Now, like I said, I own some ETFs and I still own some stocks. So it doesn't just mean that I'm just going to sleep in one place. So example of a portfolio. So I'm going to give you a big example of a portfolio. Now I'm investing with $1,000. So I will place 80% of that $1,000 into diversified ETFs and 20% into individual stocks that I understand very well. This provides diversification while allowing exposure to specific companies. Remember, this is only an example and I'm not giving you an investment advice. Your choices depend on how your goals are, your risk, your tolerance, your financial situation. Don't follow me. Me and you are not the same thing. Do according where I am from, they said hang your bag according to where your hand can reach. So please do that. So the final verdict is ETFs or stocks. if you are a beginner looking for simplicity and diversification, ETFs are good and a strong starting point. But if you enjoy researching businesses and are comfortable accepting higher risk, then why don't you just do stock? The important thing isn't choosing the perfect investment, actually. It is starting, not even choosing the perfect one. It's starting that is the cocoa. So don't do investment as if it's a sprint, like kick off, poof. No, do it like a marathon. And in a sprint, you invest all your energy, but in a marathon, you just invest little and little of your energy till you reach the finish line. So let's do a little recap. Stocks gives you ownership to individual companies. ETFs allows you to invest in multiple companies. Stocks offer higher potential returns and higher risk, while ETFs provides diversification and simplicity. So many investors still use both, but for most beginners, ETFs are often the easiest way to start. So if you found this video helpful, make sure to like, comment, share, and subscribe. And don't forget, when you start, just start simple. Thanks for watching. I'll see you in the next video. Bye.